Welcome to the Explainer. Today, we're taking a seriously dense, data-heavy corporate document, Humana's second quarter 2026 financial results, and we're going to translate it into a clear, compelling story. You know, corporate earnings reports can often just look like a giant mountain of spreadsheets and financial jargon. But beneath all those numbers, there's always a really fascinating narrative of business momentum fighting against market resistance. And that is exactly what we're going to unpack today.
Our focus for this analysis is Humana, which is without a doubt one of the absolute titans of the American healthcare and insurance landscape. The core objective of this explainer is to figure out exactly how Humana navigated a highly complex healthcare environment to generate massive revenues this past quarter. I mean, to put that into perspective, we are talking about consolidated revenues of nearly $40.9 billion for a single quarter. We're going to break down how they did that, where the growth is actually coming from, and the hurdles they had to clear along the way.
Okay, let's dive into this. Here's our roadmap for today. First, Q2 earnings at a glance. Second, the Medicare Advantage engine. Third, CenterWell and strategic expansion. Fourth, navigating friction and headwinds. And finally, the road ahead.
Section 1. Q2 earnings at a glance. The bottom line up front.
$7.61. That is Humana's Q2 adjusted earnings per share, or EPS. This is a massive number that shows some serious operational strength. And what's truly fascinating about this figure is that it didn't just come out of nowhere. The first half of the year went exactly as management predicted. In fact, this performance was perfectly in line with the expectations they set at their Investor Day last year. For a company of this sheer size to hit their operational targets so precisely, that means their forecasting and execution are highly synchronized.
But you know, we really need to humanize these massive financial figures. This isn't just money changing hands, it's healthcare. This quote from Humana's president and CEO, Jim Reckton, hits the nail on the head, connecting the billions of dollars back to the core mission. He says, when we get the clinical care right and run the business more efficiently, everything else follows. Stronger earnings and better health and experiences for the people we serve. It's just a great reminder that in this industry, clinical excellence and operational efficiency are the true drivers of the bottom line. Let's move to Section 2 and see how this builds. The Medicare Advantage engine, driving revenue growth. Before we look at their performance, let's bust a little Wall Street jargon so we're all on the same page. You're going to hear the term benefit ratio a lot when looking at health insurance earnings. Simply put, the benefit ratio is the percentage of premium revenues that a health insurance company actually spends on clinical services and quality improvements for its members. So, if a company takes in $100 in premiums and spends $90 on patient care, well, their benefit ratio is 90%. A higher ratio means more money is going directly to patient care, which is awesome for members, but obviously it leaves tighter margins for the business. Now, what's really interesting about this is that Humana's actual Q2 insurance segment benefit ratio landed at exactly 91.2%. Why does this matter to us? Because they previously told the market to expect a ratio slightly above 91%. They literally hit the target right on the nose. In the wildly unpredictable world of healthcare claims and patient utilization, managing your costs this closely to your projections is a major signal of stability to the market.
So what is actually fueling this massive Medicare Advantage engine? Well, several powerful tailwinds. First off, they're projecting an incredible 25% growth in individual MA membership over 2025. That is explosive growth for an established market player. On top of that, they're seeing higher per-member premiums, increased benchmark funding from the Centers for Medicare and Medicaid Services, and higher Part D direct subsidies as a result of the Inflation Reduction Act. All of these factors are just stacking together to drive those top-line revenues through the roof.
Moving right along to Section 3, CenterWell and strategic expansion, building the ecosystem.
And this brilliantly illustrates just how fast this ecosystem is growing. Just look at this year-over-year revenue jump for CenterWell. In Q2 of 2025, they brought in roughly $5.5 billion. Fast forward to Q2 of 2026, and that number surged to nearly $6.8 billion. That is a massive leap in a single year. It proves that their strategy to expand beyond traditional insurance and move directly into healthcare delivery is paying off handsomely.
So how exactly are they pulling off this CenterWell growth? It's happening on the ground through some very deliberate steps. Step 1, they added nearly 131,000 new senior primary care patients, representing a 27% year-to-date growth. Step 2, they're expanding their payer-agnostic client base, meaning they're providing care to patients who aren't even on Humana insurance plans. And Step 3, an absolutely massive strategic win. They broaden their footprint by winning a statewide Illinois Medicaid managed care contract that goes live in January 2027. And here is the real kicker on that one. Humana was the only new entrant awarding the contract alongside 5 incumbents. Talk about making an entrance.
Section 4. Navigating friction and headwinds, the cost of doing business.
Now look, in business, engines create momentum, but the market always pushes back with friction. The source report details 3 primary headwinds Humana is fighting against right now. First is a previously disclosed revenue headwind tied to their bonus year 2026 star ratings. Second, they're dealing with higher benefit ratios from all those new members they just added. And honestly, this makes logical sense, right? When you bring on a massive influx of new members, they generally cost more upfront to treat and stabilize before their care management becomes more efficient over time. And third, they experience lower favorable prior period medical claims reserve development compared to last year. Basically, the reserves they held for past claims didn't free up as much capital as they did in 2025.
When you combine those massive revenue engines with these specific headwinds, it creates some pretty complex accounting. Without getting too deep into the weeds here, GAAP stands for Generally Accepted Accounting Principles. But companies often provide an adjusted number to show what they believe is their true operational reality. In Humana's case, non-cash items like complex accounting adjustments for outside investments created a significant gap between their GAAP earnings of $5.73 and their adjusted operational earnings of $7.61.
So the crucial point is how this friction impacts their future projections. If you look at their full year 2026 guidance, you see a really stark divergence. They actually had to revise their GAAP EPS guidance down to at least $6.52, largely due to those star ratings headwinds we mentioned a minute ago. However, because they view those as specific adjustments outside their core operations, they firmly affirmed their adjusted EPS guidance at least $9. They're basically telling the market, yes, we have accounting and regulatory friction, but our core operational profit engine, it is still completely on track.
Which brings us to Section 5, the road ahead, Humana's destination.
So where does all this leave them for the rest of 2026? Well, despite the headwinds we just discussed, their affirmed full-year targets remain remarkably solid. They're projecting an insurance benefit ratio of 92.75% for the year, showing they fully expect to keep a tight, predictable grip on medical costs. They are locking in that explosive 25% individual Medicare Advantage membership growth target. And as we just saw, they're holding the line on generating at least $9 in adjusted earnings per share. It's a picture of a company absorbing market friction like a giant shock absorber without letting it derail their core operational trajectory.
Which leaves us with a really fascinating final thought for this explainer. As Humana balances this explosive Medicare Advantage growth and their CenterWell expansion against rising regulatory complexities and the sheer cost of upfront patient care, can their clinical efficiency actually continue to outpace market friction in the long run? I mean, they are managing the balancing act beautifully right now. But in the ever-shifting landscape of American healthcare, that is the multi-billion-dollar question to watch moving forward. Thank you so much for joining me to unpack these numbers. Keep questioning, keep learning, and I'll see you in the next explainer.